And please welcome David Bassanese.
Thanks, Peter, and it's great to hear your upbeat economic outlook. And I would say I do broadly concur with your outlook, and it is contingent on Donald Trump and China doing a trade deal. And I think for the reasons you outlined that they will do a trade deal, because he may be crazy, but he's not that crazy to risk a recession in 2020. And I think without a trade deal, the market optimism we've seen in the past few weeks will fall in a heap, and we are seeing signs of weakness in the US economy because of the trade tensions. So they really do need to lift. So with that having been said, so really I'm here actually with two hats on today. I'm Chief Economist at BetaShares and have been for 5 years. And as you may know, we're an ETF provider. We have over 50 ETFs on the market. Some are passive. And ETFs are often known as passive, index tracking, low-cost investments. But the structure of an ETF, which is basically an open-ended managed fund that you can buy and sell on the ASX, does lend itself to active managed funds as well. There's no reason you can't have an ETF that's actively managed. And in fact, groups like Magellan, or obviously very well known, and even the Switzer group do have ETFs on the market that are actively managed. And some of the things I'm going to talk to you about are some funds that we have in partnership with Legg. And again, we have a privileged position where we can really partner with anyone we like who wants to partner with us, obviously, but who we think are pretty good managers. Obviously, we wouldn't partner with anyone who we don't think has displayed good performance and we think should continue to display relatively good performance. So I'll get into that in a minute. I've only got 15 minutes, so I'll get right through it. So just in terms of the income challenge, I'm sure you've heard this many times already today, but this is the challenge. This is long-term interest rates going back, way back to the 1990s. You may remember back in the days when mortgage rates are at 18% and we had the recession we had to have, and it's really been downwards ever since. And so the RBA cash rate now is 0.75%. I think on the way to 0.5%. If there is some good news, it's that I don't think the RBA will cut rates to zero or go negative, simply because I don't think they see any benefit in going much beyond 0.5. The banks are already struggling to pass on rate cuts in terms of mortgage rate reductions as it is. So there's that. If you buy a broadly diversified bond fund in Australia, something like the Bloomberg Aggregate Bond Index, that's giving you a yield of around about 1% as well. So even bonds are not giving you much joy. Funnily enough, this is, I think, quite an interesting chart. If you look at the equity market returns, they're actually held up pretty well so far. So the dividend yield, remarkably for the Australian market, is still, pretty positive, and actually is held up at the current levels over recent years, even in the face of declining interest rates and bond yields. So, as everyone has been saying, if you want income increasingly, if you want to sustain decent income returns, you need to take on more risk. And typically getting into the equity market or some unlisted type of assets as being discussed today. Now, what's the case for active? You can buy a passively managed fund that does invest in high income stocks or bonds to the extent you can. But there are a couple of arguments for active funds management, one of which is this. For example, if you look at the ratio of dividends to forward earnings, so the orange line there in the top chart is forward earnings. It's a measure of earnings of companies in Australia, and the dark line is dividends, so the trailing 12-month level of dividends. As you can see, those lines are actually close to touching now. So the payout ratio, so the ratio of dividends to earnings, is quite high in Australia, suggesting companies are trying their darndest to keep paying out dividends, even though earnings growth has been quite flat. So that gives a risk of earnings downgrades, and in fact, I've had this chart now for a while now, but we've seen that Westpac and among others, are coming out with dividend cuts. So the risk is that the market, the level of dividends, although attractive, is probably a bit unsustainable in the face of quite weak earnings growth. So a good active manager, that the case for active here is they should be able to pick between, companies likely to sustain dividends and those that may well need to cut dividends. The other case for active, of course, investing in the equity market, price returns, income is one thing, but you also got to wear the capital volatility. So the average, average standard deviation, well, not to get too technical, but the average percent change in share prices from one year to the next is something like plus or minus 20%, 15 to 20%. So it can be very, very volatile. And of course, if you invest in individual companies, you're taking the stock-specific risk. So the investment outlook, I think the economy is going to remain pretty soft. I'm less upbeat than the Reserve Bank is in terms of economic growth next year. They do see economic growth picking up gradually over the next couple of years. I think the one problem though is the housing construction sector. House prices may be starting to rise again in Sydney. I don't think they're going to rise in a big way because they're already very expensive or starting from a quite expensive level. But housing construction is turning down. And the direct and indirect effects of that will, I think, start to undermine employment growth and cause the unemployment rate to lift next year. So again, interest rates are likely to stay quite low. Fixed income returns, so I think what the RBA will do next year is an Australian form of quantitative easing, which is effectively buying up government bonds, possibly corporate bonds and mortgage-backed securities, these sort of things, to try to keep it downward pressure on longer-term interest rates. And so that will support returns from the bond market. Defensive income in our market, so our equity market, I think, will lift with global markets, but I mean, we don't really have a lot of earnings upside for our market. So just quickly on the investment opportunities, firstly is we have an actively managed bond fund in partnership with Legg Mason. BNDS is the ticker code there, and its aim is to beat the Bloomberg Composite Bond Index. So that's the indexed, the Australian index of bonds. If you were to buy an index tracking fund, that's sort of largely what you would get. And as you can see, it does take active bets. If you notice here, the Bloomberg Composite is really heavily weighted to low-yielding government bonds. And the Legg Mason fund at the moment is more skewed toward corporate bonds that do offer a relatively high yield. And so again, in a relatively benign global interest rate environment, barring and without a recession, I don't see a recession in Australia next year, although I do see sluggish growth. That suggests a good argument to get yield pick up by having exposure to corporate bonds. And so that's an example of an active tilt that Legg Mason are doing in that fund. It has, over time, I mean, active managers really struggle to beat indexes over time. If you look at surveys, equity managers have a hard time beating the market. Fixed income managers have an even harder time beating the market. This fund, on and off over the years, has tended to outperform the global composite index, as you can see from that chart as well. So again, it's not a bad effort to be able to beat that index because, again, many managers on average do struggle to beat it. The other advantage of bonds, of course, is that when equities sell off, you're getting this diversification benefit. So this is the orange bars there are past periods of equity market decline, most particularly in 2008 where the equity market was off 30-odd%. And as you can see, the Legg Mason bond fund, similar to other funds that do invest in fixed rate bonds, does tend to do well when equities do poorly, and that's because when equities do poorly, bond yields tend to fall, central banks are cutting interest rates, and the value of fixed rate bonds goes up when bond yields fall. So again, you're getting that income and the diversification at the same time. The next two exposures are in the equity area. So the EINC is an actively managed equity fund. So again, the idea here is to invest in Australian shares, those offering an above market average dividend yield, and trying to pick companies that are offering a good yield and are likely to sustain that yield over time. And as you can see, some of the active sort of tilts in that portfolio vis-a-vis the ASX 200, more of an exposure to the mid to smaller cap parts of the market. So you're getting, one advantage is you're getting less exposure to the large caps, which arguably are struggling at the moment. The banks are struggling. The resources have had a good run, but with iron ore prices coming off, maybe they're going to struggle as well. So you are getting some active tilts in that regard. And just some examples of the exposures there. JB Hi-Fi, NAB, ANZ. So as you can see, it is doing active tilts and sort of even picking amongst the banks, those that are likely to generate better yields than others and sustain those yields. And so some active tilts there in terms of the portfolio. And again, over time, it's managed to do pretty well against the ASX 200. Looking at its forecast yield, so at the moment it's got a forecast portfolio yield, including franking, of about 6.3% as at the end of September. The last one is RINC, R-I-N-C is the ticker code, and it's the Legg Mason Real Income Fund. So this fund, again, it invests in listed securities, but it invests in both REITs, utilities and infrastructure funds. So again, you can invest in typically in Australia like an A-REIT index, tracking the property index, but you've got all your eggs in the property basket when you do that. And this fund basically can not only invest in REITs, but also in utilities and infrastructure funds. As those examples. So giving you more diversified exposure. Just if you look at this slide here, it's actually slightly underweight. Well, you can see it's underweight REITs relative to a REITs index, as you would expect. Slightly underweight retail and offices, but giving you much more exposure to utilities and infrastructure. And as you can see from that other line, it has a more even spread in terms of its holdings across the fund. Compared to, say, the ASX REITs 300 index, for example, the top two property trusts in the REITs, the indexed REITs index, account for 1/3 of that index. So you're taking a lot of company-specific risk when you invest passively in a REITs index, for example. And again, just some examples of the holdings within that fund at the moment. You can see it does have some retail property exposure. The Century Group. Just incidentally, if you actually go back to this slide, the Goodman Group has a big weight in the REITs index, for example, but a very low weight in the RINC index. That's an active bet that the Legg Mason Group that run this fund think one of the biggest property funds in Australia, rightly or wrongly, think are overvalued, and there's better value in other parts of the market. And I can tell you they actually don't mind retail property exposures. They're generating good income, and they see a good future in retail malls, the shopping malls actually reinventing themselves into becoming lifestyle places with cinemas and a whole bunch of other things, not just more traditional retailing. So that's a big active decision on the part of the RINC fund as well. And as you can see, they're also not only REITs, but also utilities, toll roads. So it's a really handy way of getting defensive income exposure across those types of sectors: infrastructure, REITs, and utilities, all in the one fund. And the good thing about the RINC fund is actually also handily outperformed both the REITs index and the infrastructure index over recent years. So it's actually been able to show pretty good active relative performance. So that's really much it. Just to sum up, these are some active ETFs, and as I said, the nature of ETFs, they don't necessarily need to be passive, and in some cases, active management can play a role. And we think we've identified a good active manager here, which in these three cases we think can deliver reasonably good returns for the the prices that you're paying for them. So thank you very much for your time.